Welcome to the Real Estate Investor Podcast. I'm your host, Gary Lipsky of Break of Day Capital. I talk to leading experts to discuss a wide range of subjects to educate investors on best-in-class practices to build legacy wealth and positively impact communities. Let's jump in. Hey everyone, welcome to another episode of the Real Estate Investor Podcast. I'm your host, Gary Lipsky with Break of Day Capital. I'm going to share with you a very informative webinar that Chad Ackerman did for those on our email list a few months ago. We do a lot of educational webinars, so if you're not on our email list, what are you waiting for? Go to breakofdaycapital.com and sign up right now. We have webinars every month. We provide a ton of high quality content to help you become a better investor. On our website, we also have some great tools and resources, but enough about that. Chad is the founder of CARE, a coaching practice dedicated to educating and empowering new and inspiring limited partners in the world of passive real estate investing. He co-founded Left Field Investors, which was later acquired by BiggerPockets and rebranded PassivePockets. Chad is going to talk about the 7 myths about passive investing. He's incredibly knowledgeable on this subject matter, so you won't want to miss this one. Most investors rely on gut feelings, shiny brochures, or hype, and that's exactly how people miss red flags and lose money. At Break of Day Capital, we do things differently. We help investors make smarter decisions before the deal ever hits your inbox. From our educational webinars to our Invest Smart book to real tools like our portfolio tracker, we're here to give you the edge most investors don't even know they need. If you've been valuing our podcast and want to take the next step, subscribe to our newsletter. You'll get early access to webinars, new investor tools, and market insights sent straight to your inbox. Break of Day Capital, because smart investing starts before the deal.
Financial advisor Bromley Palamountain of Northwestern Mutual empowers people to make their financial dreams a reality through purpose, clarity, and design. Be sure to check out his links in the show notes.
What's really holding people back? Most of the time, it's misconceptions that I've seen. It's people just struggling. They're stuck in the analysis paralysis, trying to find their way through. And it's that education that I want to help bring to kind of alleviate those misconceptions, help people take those. Now, I'm no better than anybody else. I believed a lot of these myths myself when I got started until I was able to get into a community and talk to people that were in the space and I could gain more knowledge about this. So that's what I want to go through and do. And I'm hoping tonight I can debunk some of these for a few of these topics that come up frequently anyway. So with that, we'll jump into that. So I'm a big myth fan, so I've got my Bigfoot picture here because I'm a big fan of the Bigfoot. But myth number one is I don't need a strategy. I just need to invest in what feels right, right? That seems simple enough. And the idea here is why do people believe it? Well, confidence, when they start into this game, typically your confidence grows. And after a few deals, people tend to let instinct take over as opposed to following their criteria. And that's a common thing that happens to a lot of investors. The truth is, without a clear strategy, portfolios tend to drift and they get off course and you don't correct. And then you end up chasing too many things. And that's where you get into misalignment, and that's where you get into emotional decisions. And to me, the more strategy you have, you take more emotion out of this whole process. And emotion to me is where you make your mistakes and where you get off kilter and you think something's going to work, but you maybe don't have the due diligence to back it up. So that's the caution I have with this kind of logic of I don't need a strategy. I think the strategy is one of the most important things that you can get into. Real world example for you. That first deal I got into in Cleveland, I got wrapped up in the sexy investment of this big building promising big returns that I jumped into it without really understanding my strategy. And as I grew and knew what my strategy was, my strategy really was cash flow. I needed cash flow because I was trying to get out of my W-2. Well, this investment in Cleveland was a 17-story office building that was going to be gutted and then turned into apartments and condos that wasn't going to cash flow for years. And so it really was a mistake to get in from my side for what my goals really were. So when I work with people, I start with goals, and we spend a lot of time on goals because you really need to have a firm understanding of what you want out of this space before you jump in. So the takeaway here is gut feeling isn't a plan, or hope isn't a plan. Define your goals, your risk, your comfort level, your criteria. Get all of that down before you start this process. And then it gives you a guardrails and a playbook to go off of do these deals that you're looking at fit into your criteria or not. You need to then be disciplined enough to stick to them. That's a whole nother thing. But the myth of not having a strategy, I think is a very poor myth to believe in, because that strategy to me is the most important part of the whole process. And my pro tip for this one is create an investor identity sheet. Go through and map out all those criteria that are important to you and your goals for this, and then revisit it when you're starting to study deals so that you can tell whether the deals align to your criteria or not. By writing it down, it makes it a little more real. So I always encourage people to write it down. I've got a worksheet on my website that you can use if you want a template even, but that's myth number one. Do I need a strategy? I'd say yes, you do personally. So myth number two, the unicorn here. So myth number two is I've already invested with this sponsor, so I don't need to vet them again, right? So here again, why do people believe this? A good first experience builds trust, and that's very important. It also creates a sense of safety then that you got to be cognizant of and make sure you understand. But the truth is, every deal is different, even through the same operator. There are new risks, there are new teams, there's new structures. So you really need to understand and vet out, is this new team still viable for your criteria? Does it still make sense? Break a Day partners with different people, I'm sure, as they have different offerings. Understand who all is going to be involved, who are co-GPs, who's in the capital stack with you, and are you comfortable with all of that structure? Excuse me. Past success doesn't always guarantee that the next one's going to operate the same way. So take your time and study each deal independently of one another, just to give yourself, the most knowledge you can on it, and don't be swayed by what's happened in the past. Real world example again. There are plenty of examples of operators that have done well until they didn't. And this mostly has been light has been shed on it over the past few years with the market shifts that have happened. So understanding that a revet of the operator and the deals that are coming through is important really got magnified as interest rates started to climb, insurance rates started to climb, and then all of a sudden operators that had good deals all of a sudden weren't. So do I want to continue to get on those deals or not? That all depends on your risk profile and so forth. So we've dealt with that a lot here lately, it seems like. But the takeaway here, trust the relationship by all means. This is a know, like, and trust business. If like you're engaged with a real a GP and you have a lot of faith in them, that's great. But always verify the details. Always make sure you go back and treat each deal as a fresh due diligence, so that you're always studying it with a clean slate and not being tainted by past history. And again, pro tip on this one, reassess every sponsor and every deal as if it's the first you've done with that operator. That way that you have this fresh look on the process when you go into it, knowing you've got some background on them, and that's helpful. So you've got some track record you can lean on, but make sure you understand who's new in the deal, who else is involved with it, so that you're comfortable with everybody that's engaged in this deal that you're about to invest in. But again, don't let familiarity be a shortcut for you. So myth number 3, if returns look good, it's probably a good deal, right? Well, again, why do people believe this? Well, a high projected return looks impressive and implies strong performance. By all means, if somebody's willing to write it on paper and say this is what they're going to do, sounds convincing. But the truth is, numbers can be manipulated. Projections are marketing. They're not reality. We often caution at Left Field and PassivePockets, beware the good marketer that maybe isn't a good GP. There's some of them out there, and a lot of them have been exposed through this market shift that's happened the last few years, but you want to be cognizant of that and pay attention to it. The real world example, back to my Cleveland building, I fell in love with it as a shiny object because they were promising 7x returns, which sounded amazing. I thought, I'm going to hit a home run. This is going to be fantastic. Well, the reality of it is the individual couldn't get his construction loan, and this deal's going under. That rather than 7x returns, I'm probably not even going to see my invested capital return to me. So this ends up being a total bust for me that I wish I would have been studying my criteria, know what I wanted to invest in. I would have passed on this one, and then I wouldn't be out that capital at this point in time. But lesson learned, you learn from these. Hopefully you don't have too many of those experiences, but they do teach you a lot as you lose that capital. But the takeaway here is look beyond the IRR. A lot of people love the IRR matrix, and I get it, but understand there are other things that need to be baked into your decision making just to help you really analyze the deal. Don't get stuck on one number. And the pro tip here is start with a business plan and the assumptions. Understand what the story is as much as what the math is to make sure it all makes sense. Just do that full due diligence when you go through a deal to make sure that it is a good deal. So myth number 4, I don't need to read the PPM if I trust the operator. Well, that is a big thing that I think a lot of people do, and I definitely fell subject to this as well. But trusting a sponsor feels good, and it's important. You definitely need to trust the sponsor, and those legal documents are miserable to look through. They are a lot of legalese. There's a ton of documents. Now, what I will say is the PPM is written, just to make sure everybody understands that that's an LP. The PPM is written from the operator to protect the operator. It's not technically there to protect the LP. So if something goes wrong, that's the document that everybody's going to go back to. So you should understand what's in it before you sign a deal to make sure you're comfortable with what the document says. And real world experience here, prior to 2021, I skimmed a lot of the PPMs that I had. I knew they had a lot of similarities, and I think that kind of made me want to skim through them a little quicker. But I didn't study things like what was the mortgage structure inside of the deal. And then when interest rates went through the roof and everybody had balloon payments due and they couldn't refi to pay the balloon payments, that hurt a majority of the operators that I knew that got hurt in this space. I didn't study that in the PPM when I was prior to 21. Now I pay attention to a lot of those things just to be sure that they're accounted for all the time, that people have learned their lesson from the last few years and are, have adjusted their underwriting to make sure that they're on par with risk that we didn't think would ever come around until they did a couple of years ago. But the takeaway here, trust is good. By all means, trust is important with all of this, but informed trust is even better. And knowing what you're signing is very important. The beauty of the PPMs is generally they have similar flow or similar content in them, but it is worth a run through on them, each one that you're going to potentially sign on before you sign, just to understand what's in it. And my pro tip here, focus on key sections that are important to you. And this is individualized. You need to pick your own. Maybe it's fees, maybe it's the risks, maybe it's exit terms and voting rights. Whatever it is, make sure you are looking at the elements that you view as important for you to be comfortable with that investment. And even a 10-minute skim is better than nothing at all. So at least take the time to run through a quick review of the PPM before you do anything. Myth number 5, distributions are guaranteed. So why do people believe this? To me, I grew up in HR. I was in compensation. I feel the same thing happens to people in a W-2 with an annual bonus. If the annual bonus is paid enough years in a row, it kind of becomes regular distribution. It kind of becomes a regular part of your income, and you feel like it's steady income. But in compensation standpoint, a bonus is discretionary. It could be there one year, it could be gone the next. Same thing can happen with distributions in the investments that you get into. So they are discretionary as well, and they're based on performance, not entitlement. So just because the PPM says that you have a preferred return, you only get that preferred return if the performance is high enough to pay the preferred return. So don't count on that cash flow being guaranteed. Really, it's hard to find anything guaranteed in this business. So, like any investment, there are risks involved, and distributions are one of them. Now, real world examples, distributions happen pretty frequently in the latter half of the last decade because the market was so positive. It was on an upswing constantly that even bad deals got bailed out by good market, and distributions came pretty consistently. After the interest rates changed and everything pivoted, that's when we started to see distribution stopping. And let me preface, stopping distributions isn't always a bad thing. That could be that an operator is doing their job to save the overall investment by stopping distributions. So I don't want people to walk away from this thinking pausing distributions is a bad thing. There are definitely cases where pausing distributions makes sense and should be done. And that's a valid operator who's making that decision to try to protect your investment the rest of the way. There are other reasons that aren't always positive for distributions being paused, but I don't want everything to get lumped into one basket here. There are many cases of good pause distribution logic. But the takeaway here, the idea is count on potential, not promises. So protect your personal cash flow, have margin of risk, have shifts in that, diversify, whatever the case may be, so that you can account for potential distributions that may pause and not upset the cash flow that you were expecting, kind of thing. Pro tip for this one, ask your operators, what happens if distributions are delayed? How long are reserves set up to be able to cover this kind of thing? All those are great conversations to have with the operator. Do it prior to writing, agreeing to the investment. And that is actually some solid questions to ask an operator to help vet them to see how they respond and decide if that meets your criteria or not in the way they respond and how they respond before you move forward. So it's a great conversation to have with an operator before you sign, is just get a firm understanding of that. I think there are a lot of LPs that are a little gun shy about distributions over the last couple of years that I think this is a much more common question than it used to be. But distributions are not always guaranteed. Myth 6. So the next one here, I can rely on others in my investment group to do the due diligence for me. So here, why do people believe it? Well, there's shared trust in community, creates a comfort level. So it becomes a shortcut. It becomes a crutch almost. You almost get sucked into that group think mentality, which can be dangerous. So be cognizant of that shared trust and what the chatter is in a community that you might be participating in, just to be sure you're following your own process. So the truth here is group insights are helpful. By all means, I encourage the community aspect. I'm a big fan of it, obviously, because I've started left field, work with PassivePockets still, but understand that they're not suitable for without your own research. You need to do your own due diligence as well, because ultimately your risk profile is your own, and you don't know that the chatter that's going on relates to your risk profile or goes against it. So you have to be careful of that. Real world experience here. So keep in mind, again, goals and strategies are very individualized and personal. So you can't rely on what somebody else thinks, because they may have different influences that are driving their decisions over what you have. So collect the data. The data is good. Leverage the community, but do your own decision making. To me, the group discussion is a data point, and you need to blend it with your own personal data points that align to your personal strategy so that you can make a solid decision. The pro tip here, use the group feedback again as input, as a data point, not a green light. Don't just go with the herd mentality. Run each deal through your own personal filter. That investment worksheet, have that criteria set so that you know what's important to you, and you can get the feedback from the group, but you don't follow it all the way through without running it through your own filters. And then myth 7, my last one here, diversification just means different operators, right? Well, spreading investments across different sponsors does feel like you're protected, and it does. By all means, we encourage, don't put all your eggs in one basket. But the logic here is, the truth is, there's more than one basket. It's not just sponsors. True diversification includes asset classes, the market, business plans, risk exposure. So there are a lot of different baskets that you need to consider when you're putting your eggs out there, not just who's running the deal by any means. So my real world example, I was heavily invested with one single operator when I started out, and I wasn't paying attention to the asset class as closely as I should, and see this dip in multifamily coming. I don't think a lot of us saw the dip in multifamily coming like it did, but that put me in a situation because I had a majority of my passive income in multifamily. That put me in a bad spot that I needed to diversify asset class just as much as operator. And then geography is the other big one, the market. The idea there being don't put all your money into investments in Florida and then a hurricane comes and takes out your entire portfolio. And you're trying to pick up and go from there. So those are the big three that we usually talk about: asset class, geography, and the operators are worth taking a look at spreading those things around. And then the takeaway here is diversify with intention. So be meaningful about this. Broaden it across your strategies and your geographies so that you minimize that risk as much as you can. You only have so much money to put into this, so you don't want to waste any more of it than necessary. So be cognizant of what you're putting out there. And the pro tip here: track your allocations. Where are you putting your money? And literally write it down, track it in an Excel sheet or whatever the case is. Put it on paper so that you can see where your gaps are and where your overlaps are, and whatever percentage you're comfortable with. I'm not saying only do one investment in multifamily. If you like multifamily, that's fine, but you probably shouldn't put all of it in multifamily. Come up with what percentage of your money you're willing to put in multifamily and go from there, but know how much you have in it so that you can pause getting in future multifamily until you rotate out of some, to maintain that criteria that you set. So again, this goes back to your goals and really spending time in your goals and writing them down to take that emotion out and have guardrails to drive off of as you go through this. But I'm going to pause there a little bit. Those were 7 kind of myths around that intermediate operator or intermediate LP as they invest that might cause them some drawback to invest in another deal. I wanted to note, I've got another presentation that does more of myths around getting into investing. And I just want to call out a few of those to give you some more tidbits, depending on who's looking at this. And if you're more on the newbie side of things, one of the big ones that I hear often is that you need to be wealthy to invest in real estate. And by all means, capital helps with this, but there are many different ways to get into this space. One of the big ones I know is a company called TribeVest that allows you to group invest with other people, friends, family, colleagues, whatever, that maybe if you have a deal you're trying to get into that's $100,000 minimum, that's too steep for you. Well, you could start a tribe where maybe you get 10 people and everybody puts 10 grand in, and then you can get into that deal. But you spread your risk out by getting in at a lesser amount. But the other tidbit, the other footnote I'll say to everybody: always ask an operator, especially the first time you invest with them, ask them if you can get in for less than the minimum. And majority of the time they'll say, yeah, we'll let you in for less than that, just to meet you and have you kick the tires and come along with us and try to figure out if we're good partners. So always ask about that. It's a good tidbit to focus on. Another one is you can't invest in if you're not accredited. I am not accredited still. I'm a non-accredited, sophisticated investor at this point. And I helped run a community for several years. I've been investing since 2018. There are deals out there to be had for non-accredited folks. There's fewer of them. It's harder to find them, but there are deals to invest in that are non-accredited. So don't let that pause you necessarily either. Another one is my financial advisor says this stuff's coming out of left field. My little paying homage to the old company. This was exactly why we named Left Field Investors what we did. Understand your financial advisors, in many cases, they're not going to get commissioned on you investing passively in real estate. So some of them, hopefully you have a good investor and they'll encourage you to look at this space. But there are definitely some out there that would discourage you because they don't get paid on it. So be cautious of that. And then passive investing means no work at all, right? Well, we coined the phrase saying you need to be an active passive investor, really is what you need to be. You need to do that due diligence. You need to spend time in your goals and your strategies, and then use that criteria to vet operators and vet deals. You get passive in a deal once you write the check and sign the document and send it over. But even after that, you need to watch the communications that come in on a deal and make sure it's tracking the way that you thought the deal was going to flow based on what the operator said to you. Keep tabs on distributions. Are they coming in as they said? So there is work to do. This isn't sit back and let it ride. There is work to do, especially up front, because like the operators, you make your money mostly on what you do up front. The LP, it's just vetting the deal and vetting the operator is what they're involved in. And then all real estate investments are the same. Obviously, that's not the case. This space has multifamily, self-storage, commercial triple net lease, retail, office. Then you get into the alternatives, as we call it, in car washes and laundromats and marinas. So there's a versatile dichotomy of asset classes to pick from that you can, by all means, look through all of them and decide which ones work for your strategies. Each one has a slightly different strategy to it. So if you're a cash flow person, you probably don't want to go invest in construction, ground up construction, because they're not going to cash flow for a long period of time. If you're looking for equity, triple net lease deals may not be your way to go, because generally they don't turn over a lot of equity because there's no value add there for the operator usually. So understanding the asset classes becomes really important as well. So I'll pause there. I've hit you with a ton of different myths and some logic behind them and everything else. But I just wanted to expose a lot of these different things that people think about, that I hear about, and talk about why they maybe are true or maybe aren't totally true, to help you with maybe your confidence as you go through this. But at the end of the day, the real barrier that I've seen isn't these myths at all. It's really just taking action. That people, again, get stuck in that analysis mode, and they just struggle with the analysis, which I get. You should do your due diligence by all means, but they have that fear of making a mistake, and keeps a lot of people on the sidelines. This is why I like to encourage people to get into communities, because you can do your own due diligence, but you can vet that with other like-minded individuals that may be looking at the same deals you are too, and test your logic and understand, so that you get more confidence, because you have more feedback then, that it's not just you that views that deal in a certain way. It would be other people, but you're never maybe going to feel fully ready, and that's okay. It's more about taking that first step, and that's usually the hardest one. But once you take it, you learn a lot from taking that step. So I encourage everybody to think about that and go through it. And then the last thing here is, you don't have to go it alone. There's guidance and community that can really drive your process and make a difference. I'm happy to help coach and have conversations. We can have a one-on-one conversation, talk about where you're stuck. But even getting involved in a community and having that group of people that are like-minded to be able to encourage you through is very valuable, I think. But the goal is to try to give you enough confidence to take the step anyway. A last pro tip here. So start by identifying what's holding you back, and then take one small step intentionally to go against that thing that's holding you back. And if you're unsure what that step looks like, then, feel free to reach out to me or find somebody else that's in a community that you trust that can walk you through that and talk about what you're struggling with and help you figure it out and help you get over that hump and see if you're ready to make that next step.
I hope you got a ton of golden nuggets so you could become a better investor. Like I said earlier, if you're not on our email list, you are missing a ton of great educational content and access to our opportunities. So go right now to breakofdaycapital.com and sign up today. Have a great one, and I'll see you next week on another informative episode on the Real Estate Investor Podcast. To all of our listeners, thanks for joining us. And if you like this episode, please head over to iTunes or Stitcher and like, subscribe, and leave a review, as it will help us reach more people. And if you'd like to learn more about what we do at Break of Day Capital, head over to our website at breakofdaycapital.com and sign up for our newsletter and fill out our investor application. We'll talk to you next week.